Welcome to the next installment of Opinions of Value, Valkyrie's very own virtual chat series. We're glad you could join us for today's episode. This series was created to encourage open and honest dialogue about the health and state of the commercial real estate industry through the lens of commercial appraisers. On Opinions of Value, we will explore everything from the trends shaping the commercial real estate market at large to challenges impacting the way valuers conduct their jobs in the digital age. We are excited to dive into today's episode with an amazing panel of guest speakers. Please welcome Ross Lightenhouse, CEO and co-founder of Taxonics and managing partner and founder at Calvary Real Estate Advisors. Returning guest, Desiree Flannery, MAI, manager with the Property Tax Commercial Group at Ryan. And finally, returning guest, Casey Conway, MAI, CRE, CCIM, principal and co-founder at Red Shoe Economics. Let's dive into the questions, shall we? Desiree, please lead us out on this question. Why is it that property tax consulting, tax appeals, and appraisals for property tax purposes represent such a prominent segment in the commercial real estate industry?
At the end of the day, it's expense management. So it's ensuring that our clients are not paying more property tax than they're legally required to do. In particular, in states that don't have that three-legged stool of sales tax, income tax, and property tax can represent a significant portion of your revenue as a percentage. And so as professionals, we're proactive in staying on top of all the ways that the outside environment is impacting our tax authorities. For example, and I know we'll talk a little bit more in depth about this later, but in Washington State, there's a bill that's currently not gaining momentum, thankfully, that essentially would try to tax wealth as a collectible under property tax. And so it's important to understand that. And really, at the end of the day, our responsibilities are to help our client meet their financial goals.
Ross, do you have anything to add to this question?
So it is the single largest line item operating expense for a property owner. So when we talk about the importance and the significance of real estate taxes when making investment decisions or operating real estate, it stands out. And if you don't manage it appropriately, it can kill a deal. You know, and I've mentioned in the introduction the amount of time that we spend helping real estate investors and developers not only manage real estate taxes, but also forecast those real estate taxes. I think that type of insight is probably more important to the industry now than it ever has been, especially when you're seeing rising interest rates, deterioration and erosion of value. There's just as much importance placed on kind of the reactive solution, which is appealing assessments, as there is the proactive, which is understanding real estate taxes. And I think, as most people know, you've got over 3,100 different taxing counties in the U.S. and then thousands of different taxing jurisdictions inside of those counties. Each one of them assess and tax real estate a little bit differently. And so it's very, very difficult for commercial property owners at any scale to really get their arms wrapped around exactly how their properties are going to be impacted by real estate taxes on an annual basis. And so that insight now, again, is more important than ever. And you kind of touched on something that's really interesting, Grant. You had talked about kind of fee appraisals, transaction appraisals declining. I think I read a statistic that on the commercial side, at least leading up to COVID, there were close to 60,000 commercial real estate transactions a year taking place. I know that that's significantly less now. So there's a lot of opportunity for appraisers and valuation experts to get into the game. But here's a really interesting statistic. I'm actually currently on a 3-state property tour right now, visiting shopping centers up in Connecticut, New York, and New York City. And I'm sitting in the office of a friend of mine who's also a property tax attorney. I won't name names, and borrowing their office. But we were having a conversation over lunch, and there's an interesting statistic I think that he and I both agree on, and that is there are probably fewer than 2,500 full-time real estate tax consultants working in the United States today. folks that are multi-generational that have that expertise like Casey are a rare breed. And there are more and more folks with that level of institutional knowledge getting out of the game, and it presents a huge opportunity for folks to get into this space to be able to offer this expertise. And when you think about, the 11 million commercial buildings that exist, most of the focus that those of us that work in traditional real estate tax consulting have had has been on that kind of top 20%, right? So the big names, the ones you read about in the Business Journal. There's this entire kind of, missing middle aspect of commercial real estate that are relatively underserved, and that presents huge opportunity, whether it's real estate agents and brokers or appraisers to step in that understand how to value real estate and are willing to educate themselves on the nuances across these jurisdictions to be able to provide those services to the commercial real estate industry. So now is really a perfect time for anyone that's looking to kind of add that extra arrow to the quiver, tool to the toolbox, pick up that side hustle. Already understanding how to appraise and value real estate is 50% of the game. The other 50% is just understanding how the game is played in a particular taxing jurisdiction. So I think it's very relevant, this topic, especially for your, Valkyrie customers, clients, friends, and peers in the industry to be thinking about property taxes as an additional service. And then the last thing that I'll leave you with, because this is, again, very topical for us too, as part of Taxonics, we actually built an online e-course to help train folks to be able to provide these services and also help them to understand how to set up this type of business. So it was kind of pulling back the curtain and showing, some of the closely held secrets and nuances of our industry for them to be able to arm themselves with, relevant education and tools to be able to spin this type of business up. And that's been very well received. And we've had a lot of brokers, real estate brokers and agents who have seen transaction volume decline that are looking at getting into this area of the industry because they see opportunity. They've used this e-course to help train themselves. And so it's really an exciting time if you can consider any time in real estate tax consulting to be exciting. This really is kind of a transitional moment in our industry, especially combined with the current market cycle. And as I've mentioned before, and again, kind of going back to your question, there really is no bigger line item operating expense that warrants more attention from a real estate operator than real estate taxes. And as Desiree knows and Casey knows, when the market is declining and folks are looking at shoring up a bottom line, as a property tax expert, you're everybody's best friend.
So I hear take the proactive approach in making sure that anything you can control on the tax side you do before they actually make the assessment. And then in terms of pressure on the appraisal industry and the opportunities available for property tax appeal appraisals, we're seeing it as well. We're seeing demand from our clients for a very specific product that will help guide them through the appeal process. Casey,
right.
Do you have anything to add to this one?
I would add just 2 or 3 quick things. So number one, remember, commercial property owners are the only entities that are taxed without representation. They don't get a vote. They own around the country. Unlike you that own your home, you're a voting member in that jurisdiction. So this may sound a little harsh, but the assessing authorities really could care less about the corporate owner. They know that they don't vote. They're not going to impact whether the assessor gets appointed or reelected. The second thing is the definition of value is incredibly important. It's different in most every state jurisdiction, and they're supposed to assess in most states the fee simple market value. And as Desiree knows, like with a hotel, you have anything but the fee simple market value. You've got going concern, you got intangibles. And so it's not just hotels that are in that bucket, but think about self-storage, think about manufactured housing. As you get into this, expand your scope where there's contributing assets that go beyond the fee simple market value and know that definition in the state. And the last thing I would say is the competency provision. This is a specialized, complex area, and you can't just jump in. Ross has got like an education offering to help with you. Partner with somebody because you need to have the competency to know how to go through it. And usually I direct people, go look at the respective state assessing authorities' appraisal guidelines, and you'll be surprised how many things are different than what you've thought in your normal practice. So just those 3 things.
Grant, can I add something to that real quick? Casey touched on something that I think is really important. His first comments about commercial property owners, taxation without representation, and being from the DC area. I mean, that's literally on our license plates. I think what's really important for property owners to understand is that you are starting to see erosion in market value, and market value or fair market value, true fair market value, is supposed to be kind of the starting basis from which all assessment valuations take place. So anytime you start to see deterioration in overall market values, you can expect for the assessment base to decline. Well, I've served as an elected official in the past in a small city that I live in, and I understand the pressures to a local budget where property taxes make up more than 50% of your local tax revenue. When market values decline, assessment base declines, all other things being equal, tax rates are going to have to go up to make up for that. Unless folks are willing to cut operating costs, which is in some cases a very politically unpalatable thing to do. Nobody likes paying more in taxes, but people also like to have snow plowed off the streets. And so in some cases, the residents' desires to have a quality of life can win out. The reason I mention that is because on the commercial side, what you will start to see, and we saw this coming out of the last recession, assessment-based declines, they need to make up for revenue. So the first place that they look are raising tax rates on commercial properties. And if you look around different taxing jurisdictions throughout the country, you'll see that in some cases there's a distinct disparity amongst the tax rate that residential homeowners pay and the tax rate that commercial property owners pay. And so there's a knee-jerk reaction when the assessment base drops to have to raise taxes to look at commercial first. And it's not just the ad valorem tax rate, which is the tax rate applied to the value. It's also non-ad valorem rates, which in some cases may come from a different taxing entity. Could be a business improvement district, could be like city center district in downtown Philadelphia. There's a whole bunch of examples of that. And so one area where commercial property owners need to be cognizant is that even if they see an assessed value drop and they think, wow, I dodged the bullet, that actually represents a decline in the market, they may come back and get hit the other way with a rising tax rate. And so from a budgeting perspective, that's one of the questions, one of the things they need to be thinking about as they're planning for real estate tax liabilities and expenses going into the future.
Yeah, absolutely. I did want to touch on Casey's point real quick, the need to have a mentor when breaking into the property tax appeal space. I have the privilege of working with someone with more than 2 decades of experience specializing in that, and it contributed vastly to my ability to navigate that entire situation. It's not like typical fee appraisal, that's for sure. All right, let's move on to the next question. Ross, I'm going to ask you to kick this one off, please. There's been a lot of disruption in commercial real estate over the past few years. First due to the pandemic, and most recently the sharp increases on the market interest rates. What are you seeing in terms of the activity level itself for property tax appeals, and how long do you expect those conditions to persist?
Okay, so from a high level, activity has definitely increased. The activity really spiked right during COVID. Then it declined a little bit, and now with rising interest rates and properties going upside down, we're starting to see that activity increase as well. In terms of length of time, I think that appeal activity is going to remain above average levels for the next 18 to 24 months. So that's kind of the short answer. If you want to dig into some of the specifics about property type and particular jurisdictions, I'm happy to dig into that. We're looking at data and information across hundreds of jurisdictions throughout the country, all different property types, and we spend a lot of our time gathering information and data. So if there's something in particular, Grant, that you want to drill down on that you think might be of interest to the listeners, I'm happy to talk about that. But that's kind of the high level answer.
Well, I do appreciate that high level answer. We won't get too granular on this one. Desiree, you're in the trenches. What are you seeing? What is your activity level compared to, say, this time last year?
I think COVID obviously brought on a lot more in the appeal world, primarily just because of tax law, values tend to lag. So in 2021, when I'm reviewing 2020 values and everyone's talking about the COVID pandemic, that data value was 1/1/20, 3 months before it hit. And having to explain that to clients, it's a challenging conversation. So those conversations haven't really stopped, especially in the hotel world, because certain markets, and there's of course a lot of press, which brings about more questions, talks about how hotels recovered so quickly. But that was really only in certain markets. In other markets, they still continue to perform below where they did in 2019, but the assessors just read the articles and pull the data of those transactions that were record beating and use that as a reason to increase values substantially. And depending on the jurisdiction you're in and that having to overcome that preponderance of evidence for successful appeal outcome, we don't necessarily have great data to show if the jurisdictions aren't willing to look at the individual properties and are only interested in looking at the market as a whole. So that can be really challenging. But I do think there's always good opportunities for appeals, even in a good market, because assessors can get more aggressive with increasing values, and we have more data to show them that they're incorrect. So it's busier now, but it's always a great time to look at that, no matter the market.
Well, thank you so much. Casey, I know you are active and across the entire U.S. in this space. What's the activity level for you, Ben?
Yeah, so it's elevated, and I think Desiree made a really important point. Most clients thought because of COVID they could appeal their 2020 taxes, but the appeal value date is January 1, so it hadn't been declared. Most everybody spent a lot of money. It would have been important for us as experts to explain that to clients, and so really 2021 was your first bite at the apple. But I'm dealing with more cases that even predate that we're dealing with industry changes, whether it was retail. I'm still dealing with big box retail, but we're dealing with 2017 to 2020 valuation dates that are working their way very slowly through because a lot of the appeal process in courts were shut down in 2020 and 2021. So knowing those retrospective dates, where I always start and remind people that they're in this business, is always start with a state of the industry around your property type. So what's happening with hotel? What's happening with office right now? So the offices, this whole remote work issue, we're not even half of us are going back to work. It's going to have a bigger impact if you're an urban office building than a suburban one. You're not going to have transactions. So you may need to use a band of investment technique to get your cap rate because there aren't transactions. The assessors generally will take shortcuts, and they'll try to do one approach to value and just be the sales comparison, and they always are looking in the rearview mirror. They're never looking forward. So I think as you're doing this and you're getting into this work, understand by property type what's happening in that industry. So self-storage went into an overbuilding cycle pre-2020. So a lot of that inventory is now being delivered today, and we're seeing occupancy and we're seeing rents decline because of that. Office, understanding the whole remote work evolution, it's not a COVID issue. It's an industry issue. The big box, the retailers, we're still already announced over 1,500 big box store closings this year from entities like a Walmart. So how do you explain to the judge or the hearing panel, how e-commerce affected, big box retail? So the phrase I use on retail and office right now is remote work will be to office building values what e-commerce was to big box retail. It's amazing how many hearing officers understand that kind of a statement or whatnot. And the other one I say on the data, the assessors, they're dealing with mass appraisal. They're dumping lots of data in. They have no idea how a CoStar data works or how a TREP data works. And so you've got to be careful to dissect that data and know what they're using. I had a case in Denver where it was in the popular Cherry Creek shopping center district area and had a property that was outside of that. And so the assessor just grabbed all the CoStar comps in the Cherry Creek shopping center area and assumed all of them were retail deals. Half of them were office building and hotel rent deals above the retail place. So they were using $30 to $50 rents for retail that had collapsed. And so the way we figured that out is in the code within CoStar that determined whether it was really an office lease versus a retail. Assessor had no clue. They had no training on any of that stuff. And that's, again, where our value comes in, really knowing the data resources that you're using. We're seeing the opportunity be broadening to more property types. Like I said, self-storage, manufactured housing. We're even going to see for rent subdivisions, which are really horizontal multifamily opportunities. Those, the private equity's pulled out, the land's dropping. Public home builders are seeing, like a KB Homes, a 68% cancellation rate. How do you revalue that land? A lot of the assessors just do a retail value. They don't understand discounted cash flow, and that you can't, just the market value is not all of that. So broadening to more property types, understanding that date, understanding that definition of value, I think are really important.
I think, yeah, I want to add to that. I think this is important to understand for anyone that's considering doing tax appeal work or representing folks for tax appeals. I mean, you're telling a story about a property. I mean, in a million different ways, it is a story that you are telling. And so broader market conditions certainly play into that. And part of that challenge, I think that Casey mentioned, is that, in the absence of really good data, high transaction volume, rising market, that's easy, right? For assessors to appraise, it's very easy. I mean, you're following those trends, tons of really good data. But in the absence of data, things like band of investment, weighted average cost of capital in a rising interest rate environment, when you don't have a lot of commercial transactions that would give you a solid indication of what's an appropriate capitalization rate for a property, that level of detail is what is going to be able to help you tell a better story around the property. One area in particular, speaking of retail, because we spend a lot of time valuing shopping centers, retail assets, mixed use. One of the areas and pieces of data that's been very, very helpful in telling a story, kind of even beyond COVID, and some of it's e-commerce related. Some of it's, frankly, it was kind of amenitized retail that were close to office parks that just, frankly, is not getting the foot traffic. That information is looking at sales per square foot numbers from tenants at a building, looking at sales to occupancy cost ratios, because those are very clear trends that you can show how tenants, certain type of retailers in certain areas of the retail industry have continued to see sales declines year over year, while occupancy costs have continued to go up. And in the retail industry, there are very clear benchmarks in terms of what level of threshold in terms of sales to occupancy cost ratio, once you hit that threshold where that business is technically in the danger zone and at risk of folding. Or if it's a national retailer, someone in corporate headquarters looking and saying, sales have been declining, our sales to occupancy cost ratio is now above 20%, we need to fold this store. So they back out of a lease early or they tend not to renew. That type of information is incredibly important. And then the last thing I would say, whether it's office, retail, any one of the kind of major food groups from a real estate perspective, is looking at what the market is justifying from a rent perspective, and not just asking rent, but net effective rent, concessions, TI, all of the stuff that's thrown into to get to a net effective rent. What is the market dictating now versus what are those tenants in place currently paying that if they're coming up on the end of their lease and that lease rate has escalated at 3.5% over a 7-year period, that rate may be well above market. And so when that tenant rolls out, whether it's earlier on time and they've got to reset that lease rate to something that's maybe 20% below, even if it hasn't happened yet, there's still a portion of that that goes into the story of the property, which is next year I'm losing 20% of my tenant stack. Those tenants are going to roll, those spaces are going to roll back to market. My NOI as it stands today is going to erode by 20% possibly. And so that's going to impact the value because, again, at the end of the day, it starts with an interpretation of what's considered fair market value. And what I love about it is, from an appeal perspective, it's our opinion. Can't be wrong if it's your opinion. Assessor may disagree. But that opinion is, if a potential buyer was to step in on this particular data valuation and pay X amount for this property, that they're going to take into consideration the fact that I'm losing potentially 20% of my tenant stack or that rent roll that's going to roll back to market rates, and what's that going to do to the potential value of the property. So that level of nuanced data is huge right now, especially when assessors are kind of fumbling around trying to find, the writing on the wall in terms of what's happening with certain asset types in certain markets. If you can get into that level of granular data, again, it helps tell that story, which is ultimately what kind of gets you across the finish line to win an appeal or get some type of adjustment to the assessment.
Let me piggyback on two things Ross said there. So our job when we're successful in this, I look at this, we're challenged to come up with the answer why. So why is assessor wrong? Why is his opinion of market rent or cap rate wrong? And so what I look to a lot are earnings reports. I read a ton of earning reports. If I'm doing a retailer on Home Depot or Bed Bath & Beyond, even going back, and I did one a year and a half ago, I look at those earnings reports, and those earnings reports under the penalty of perjury to the SEC, they tell you what is coming at you. And so they'll tell things like, so in one particular one with a big box home improvement center, they brought in when lease accounting was being brought in. And they talked about in the earnings report that, 5, 10, 20 years ago, we didn't care what the lease rent was, not the market, what the lease rent was, because we didn't have to record the lease as a liability on our balance sheet. So who cared? It was a financing mechanism. And being able to dig that out of an earnings report saying that what was influencing those really high rents in big box was the influence of lease accounting, and that I didn't have to put it on my balance sheet as a liability. And now that changing means now they have to pay attention to what is the market rent for just the real estate. So, think about that why questions that you're going to have to explain and where you can go for really good data. So I use things like TREP, I use the earnings reports, I go behind the scenes and bring those in. And that's what really influences, I think, a hearing officer or a judge, which are primarily lay people. They may have some familiarity with residential, but they don't have any experience with the complexity of the subtleties of your commercial real estate. So I think you're exactly right, Ross. And I know, Desiree, you on the hotel side, having to try to explain what a hotel is. It's a business. It's not real estate.
Yeah.
Sure.
Absolutely.
So we in the answer to this last question, there was a handful of asset types that you guys mentioned. In your guys' opinion, what are the top 1 to 2 asset types that are most ripe for successful property tax appeals? And we'll start out with Ross.
Okay. I think we've touched on a few of these. I'm going to put office right at the top of that for the obvious reasons, and I won't beat that dead horse because I think everybody understands why office is struggling. The second I would say is retail, which again we've touched on. So I'm going to throw a third in there. I'll let Desiree talk about hotels because that's her space. But I'm going to throw a third in there that may not be on a lot of folks' radar. And it's not because they're not in vogue and they're not being invested in. It's because of the misunderstanding in terms of how they're supposed to be valued, and that is data centers. So my backyard in Washington, D.C., Loudoun County, Prince William County, it's data center alley. 75% of the world's internet traffic runs through Northern Virginia, and there's a proliferation of data centers. If you ever fly into D.C. and fly into Dulles and you look down at what looks like big box stores and massive warehouses, those are data centers. And they drive an enormous amount of local revenue to the jurisdictions, to the point where Loudoun County has one of the lowest tax rates in the country because of all the money that they make off of the equipment and the data centers themselves. But here's why I say there is an opportunity in data centers, because they are incredibly difficult to value, to extract everything but the real estate associated with that particular property. So you're extracting all of the equipment, you're extracting all of the intangibles. There's a business component to it because tenants will pay a certain amount to lease space at a data center based on who owns it, who operates it, latency, downtime characteristics. There's a whole bunch of things thrown into it that are not real estate related. And as everybody on this call knows, you have to only tax the real estate when it comes to a real estate tax assessment. And so when you really dig into the nuances of a data center, trying to extract what goes into the income that data center owner generates off of that property, it's very, very challenging. And there's still a lot of education that's taking place around the country in the assessment community to be able to understand how to appropriately evaluate those. And so if kind of, hotels and the Red Roof Inn case in Maryland with David Linhoff and other appraisers was the in vogue, complicated, mental gymnastic, how do we value a piece of real estate just to get to the real property? If that was in vogue 20 years ago, I would say data centers are going through a similar kind of analysis and a similar kind of rebirth in terms of this academic conversation. And so we have found, even though they are in vogue, even though people are continuing to chase those and there's a ton of transaction volume and they're a very, very popular asset, there's still a lot of just objective misunderstanding in some jurisdictions in terms of...
As mentioned, hotels are always a popular topic. I don't really see that changing because it is and will continue to be a challenging topic to learn and understand, especially on the assessor side of things. Really, the best thing is looking for what assessors are getting wrong. One example, although it's certainly not as sexy or high value as data centers and hotels, is senior living. In the Pacific Northwest, for the most part, assessors will use the cost approach because they are leery of using the sales or income approach, since so much of that revenue or purchase price is due to the services. And so those properties do tend to be undervalued. But if you find an assessor that's decided to be aggressive and start using that sales and income approach, that can open a huge world into appeal opportunities for our clients. So it's things like that, looking at what these jurisdictions are doing incorrectly, especially when there's a lot of great data to show them how to do it correctly through that appeal process and making money.
Absolutely. It seems like specialization isn't really that much of a thing on the assessment side because of the broad range of properties that they have to tackle. And so quite often they don't get it right simply because they don't understand the property, a specific asset type well enough to determine what the appropriate valuation methodology looks like. Casey, what other asset types would you, I'm sure you have additional opinion here.
So Desiree and Ross will love this. So I actually do read my 14th and 15th edition of real estate. And if you go to chapter 35, I think one of the most important ones is the total assets of a business. And they break out what's the tangible in the real estate and the non-real estate. This is an incredible chart that most hearing officers have never heard of. It's in very few of the appraisal training manuals by the different states. So I think Ross said office is going to be incredibly important because remote work impact on office is going to be as impactful as what e-commerce was to big box retail. And we're a decade into the big box retail. In 2019, we had 9,300 store closings going into COVID. This year, we've already had over 1,500, and it's not done. And so, again, understanding they all want to use what was the lease rate or the rent in that store. And that rent was negotiated years ago. It may have included a lot of intangible. There's one big box retailer that every merchant developer that built their store included in the rent had to be the first store's inventory. So you were amortizing the value of store inventory that was several $1 million. So the 15th edition of real estate says that you can consider those assets that were leased or had a triple net lease, but you have to have the lease. You got to know the date that it was done because it's not relevant to the current market period. You got to understand what else is in that lease that's amortizing or the intangibles in there. So I think office and retail are very big. We're not done with retail. It's a lot of adaptive reuse. But what we're seeing right now that'll puzzle people, look at the Bed Bath & Beyond bankruptcy. Those stores are being gobbled up because we haven't built much big box. And many of them had really different, unique locations that we have a competition occurring for. So the assessor is going to jump on that and say, see, look at all these new fee simple rents that are in there. But it probably that rent is going to include amortizing the complete retrofit of the thing. So I've had one with a Kmart where they made it into a gym and they amortized all the gym equipment. And that's not real estate. So we really have to have that lease. And if the assessor doesn't have it, they can't consider it because they don't know what they don't know. So I think the office, particularly in the urban areas, I think we're seeing less impact in the suburbs. On the hotel, Desiree, I'd be interested in your thoughts on this. So a term that I helped coin last year was boo leisure. So the leisure that has a business element. So when I go to Salt Lake, or I just came from Palm Beach, those hotel assets are booming. Because I can extend, because of remote work, I can extend my time there, spend an extra day in Palm Beach, spend an extra day skiing. And those hotel assets are outperforming anything they've ever done. They've cut their expenses. We use our smartphones to do our login. They've cut maid service to only when you check out. They'll drop some towels by. They've cut food because I can go on and order Uber Eats. So they've cut expenses by about a third from the old model. And the revenue is way up. So we may actually see hotel assets where they're coming back in for increases rather than, taken out because of the recession. Multifamily, we're going to have to look at differently as well because the cost of capital issues. So when the assessor says, okay, I'm just going to look in the rearview mirror and I'm going to average every multifamily comp in CoStar's database and that's the cap rate and I'm going to put 5 on it. Well, that's not the cap rate today. And when you look at the cost of capital, so we kind of have to have the competency to dissect these things. And that's why I always start with the state of the industry. What's going on with the hotel industry? What's going on with retail? What's going on with the office? That sets the stage for why this property type is distressed or ripe for property tax appeal. And then I translate those national trends to local because you may see, in a commercial property price index where it says everything's going up or it's not gone down as much. But then when you translate that down to the local market in Real Capitalytics, CPPI, you find that it's more distressed in certain markets where people are moving away. The last thing I say that helps do that is we're going to see a big assault on industrial. Industrial's been going up through the roof. Nobody understands what's going on in that big box, how specialized the construction is, the floors that have electronics for robotic forklifts, the height of the ceilings, all of that type stuff. And no two are created equal. And what they mean in terms of the impact, one of those 500,000 to million square footers means that retailer can probably close 50 to 100 stores. So they care less about, there really isn't a market rent. It's the cost of that asset that's going to save me expenses across the board. And so I look at industrial is going to be the big one. They're going to look to make up for what they're having to give up on office. And we need to think about, so where are they losing property taxes and revenue that they're going to have to make up for? And that might tell you where they're going next. And I think, like you said, Ross, data centers, life science, industrial, what's worked really well. Boo Leisure now is working very well. They'll go after Boo Leisure rather than conference center leisure in Atlanta and Las Vegas or Dallas. And but I think the office side, we're going to have to be very prepared to tell how remote work is having an effect. And the resource I use on that is something called Castle Systems. So Castle Systems invented the key cards that we all use to access, and they tell us who's going back to work by city, by state. And we have not even gotten back to 50%. The only place that got above 50 was Texas. And so that's telling us systemic, whether ABC state or DEF state or city. And so those are the data sources I'm looking that are good primary. They're not surveys. They're credible. And when you introduce those into the appeal process, it's amazing how you start to get the lay judge or the lay hearing officer's heads start to nod even on a Zoom call, and they forget they're not in person. And we can see that head nodding. That's where you make a difference. So I think office is going to be very challenged. We're not done with retail. Industrial, Boo Leisure, and the specialty like life sciences are going to be up there. And they're going after the self-storage in a big way. And we need to understand when REITs buy portfolios of assets like self-storage, that's a finance transaction. They're buying a going concern first, and the real estate is there. We've got to be able to dissect and how that REIT transaction is not atypical of the market.
Well, first, let me say this, Grant. You talked about assessors and the challenge that they have with data. I think it's important, especially if there are assessors listening into this. In many cases, assessors are overworked, under-resourced. And so a lot of our job is to educate, right, and bring in that national, local, property-specific information into a collaborative discussion to say, hey, listen, here are some things you may not have considered. So that's important. Second, Casey, you talked about office, and I think one of the office trends that we've been following for a while, certainly in the DC area, that I think anyone that is looking at office assets, remote work, all of the kind of overall market impacts that are taking place, federally leased offices or offices that have a number of anchor tenants that are federal agencies need to be very, very concerned and needs to be following very closely the trends in the downsizing in the federal market. And that's agencies. It could be government contractors associated with specific contracts with those agencies that may be moving. We're seeing really, really disturbing trends, and we have a number of properties wrapped up in litigation and under appeal where it could be the General Services Administration or some other independent agency that has just decided not to renew, even though they've been there for decades, or terminating early and leaving an absolutely astronomical amount of space, dumping it back onto the market in some relatively small submarkets. The GSA is doing a couple things. The federal government's doing a couple things. One, they're downsizing the overall square footage per FTE. Lawyers take up the most space per FTE. After that, it's the federal government. And so they're moving from this kind of higher 200 plus square foot per FTE down to what's closer to the professional services industry benchmark, which is in some cases 100 square feet per FTE. And so if you look at the overall amount of space that's being leased by the federal government throughout the country, if they were to cut that by 20-30%, that's going to have massive impact on certain markets that are already seeing 20% direct vacancy in the office markets themselves. The other thing that we're seeing related to the federal government is their desire to move out of some of these more expensive markets. There was an article that came out just a couple weeks ago talking about the federal government's commitment to remaining remote permanently. And so in some cases, only asking a portion of their employees to go back into the office 2 days a week. And in DC, it's Tuesday, Thursday, and you can see that traffic on the Beltway. And that type of knowledge and expertise And that book right there, in some cases, can carry the day because it certainly helped us win our case in the state of Maryland. So that's my plug for Valkyrie, for the appraisal community. You guys are in the spotlight when we get to court in property tax consulting, and only you guys. So there you go.
Well, thank you so much for that plug, Ross. Much appreciated.
I'll just add one quick thing. So I go way back. So being a scarred third generation MAI, I have all my grandfathers and fathers' original texts, and I bring these to court because you can't find them on the internet. But this was the original encyclopedia of appraisal. And going back to 1950s, they had all the definitions of value, and one of them on a case that I just won was on explaining to why this entity had paid so much for office buildings in West Palm Beach, for everybody moving from New York down there. And we won on that. Really what the assessor was misinterpreting was capricious value. So capricious value, and this is defined all the way back, the judge agreed, an expression sometimes used to indicate the excess of price paid over the market as a result to a particular purchaser. So this one purchaser came down to Palm Beach and bought every damn office building. He didn't care what it cost because he knew he was moving everybody out of Hudson Yards into New York, and that the $30 or $40 rents were still a third or a half of what they were in New York. And so we explained that's not the market. That was one buyer that bought all the buildings. And if we looked at Boca Raton or anybody else, there was nowhere near those numbers. So we won on capricious value. So it pays to kind of think these things through. And I think, the other thing on what Desiree just said, one of the things we deal a lot with is assessors, they have to take shortcuts. So they look at national indices, whether it's self-storage or NCRE or whatever on the published, here's the overall expenses, here's the overall ratios. And those are great for a national level, but they're not local. And if you go tie it in to their local state appraisal guidelines that are part of the statute, it tells them they can't take those shortcuts. So as much as they want to do that for mass appraisal, that violates the statute. And that's why I say spend time learning the statute, learning the provisions, and reading the appraisal guidelines, because what you'll find, I just did a case in Florida where the Appraisal Institute, this little book, was footnoted over 80 times in their appraisal guidelines, and then USPAP was cited over 20. And so even though they wanted to say they don't have to follow USPAP, then why are they citing it in their appraisal guidelines? So that's the thing that take extra work, the extra knowledge, the extra competency. Don't just take one on yourself first time. Associate with somebody that will help you. I did that early in my career, and I'm still learning. Every time I take a case, I have a handful of people. My good friend Todd Jones at Real Advice down in Florida was the one that won the Disney case that got the Rushmore method thrown out in the state of Florida because it didn't fully cover the intangibles in there. So find those people. I still talk to them. Did I do this right? If I missed something, really do that side.
I have one more comment to that too, is not only, what the appraisers for the counties are looking at, the jurisdictions, but also what the board requirements are. So downloading and reading through the guidelines that are provided for the members of the board that are hearing your cases, because that a lot of times, because they don't necessarily have a valuation background, don't even necessarily have a commercial real estate background. So they really rely on that book and looking through that as well, and knowing that as a way to craft your argument and bring them to your side.
Oh, that's an excellent point. Desiree, it's your turn again to lead off. So with the slowdown in the finance appraisal work and a major uptick in property tax appeal activity that we've discussed, I'm sure there's a lot of commercial appraisers that would be very interested in trying to break into the property tax appeal space. What advice do you have in terms of being able to position themselves to break in?
I think the first thing is figuring out how you are going to get paid as an appraiser, because as a licensed professional, we have those guidelines with USPAP about how we are paid and how not to be misleading. So a more direct or easier route, if you already have that licensure, is being hired by a tax agent or an attorney to prepare an independent third-party appraisal, and then working with them to really understand the property tax law for that jurisdiction. So your USPAP compliant appraisal is also taking those other factors into account as it can. And then, of course, if you're interested in being a representative, or if your client's asking you to be a representative, how are you going to take off that appraisal hat? Because for the most part, we're paid on contingency. And so you can't be acting as an appraiser in those circumstances. So figuring out if that's an option, or most likely it's not if your goal is to go back to just standard work once the markets change.
What advice do you have, Casey? If I wanted to be a property tax appeal appraiser, what are you going to tell me?
So the first thing I'm going to tell you is find out who the law firms are that do property tax appeal, because it's the law firms that represent the clients that hire the appraisers. And they have a database that looks at who's really good, who's really not, who wins cases. So I usually do pretty well because I haven't lost a case in 27 years. That means I'm going to lose my one next week.
Don't jinx yourself.
That kicker has never missed. He's going to miss this one. So there's a couple I do. So I do more on the property owner side. So there's an organization called the American Property Tax Council, APTC, and they have basically a few of the law firms in each state that represent the big entities, the Home Depots, the Marriotts, the Hiltons, that decide where they're going to go. Are they going to battle California this year? Or are they going to stay out of there and really, battle along the East Coast? So they represent the property owners that have made a conscious attempt to say, you know what, we're going to put $1 million in a bucket to go after and appeal these assets in these 3 or 4 states to set some precedent. The second one is go to industry conference like the IAAO, the International Association of Assessing Officers. You can find ways to attend and go, but understand their thinking, understanding what they're pointing at. We really need to now defend the lines on office or whatever. They have a lot of programs that will help you understand their thinking, where their logic comes from. The big box paper where, they're trying to say there was no more allocation of property rights, that everything was fee simple. That's where I say barbecue sauce. That's my polite way of saying BS. In the South, the polite way you call BS and something is call it barbecue sauce. So, but go to these industry conferences. And then 3, you're going to really honestly have to probably look out of the Appraisal Institute for really good granular competency education, like what you do, Ross or Desiree. The Institute will scratch the surface, but if you really want to go deep, you're going to have to go outside, look at professional industry, find out where the law firms are. Many of them I go to, 3 or 4 of the big ones, they hold an annual conference and they invite appraisers in to help tell them and educate them about things like, the definition of value really is the same in their guidelines as our understanding of fair market value. Or they'll let they'll bring up issues like Ross saying, as an appraiser, we need you to help us understand where there's a lack of uniformity. Like in Pennsylvania, they just make this crap up. They only pick on those that sold recently or who they want to. And the assessing authority is the school districts who are claiming that us evil appraisers are taking lunch money out of this children's mouths, and that concerns, the hearing officer. But they will look to us to say, let's look at the other 10 properties that are similar to this and how the disparity is 100% in the value of taxation. And if they fail on uniformity, that's a real serious thing. So I would say go to the industry, go to find out the law firms within your state or your city. A lot of times accountants as well. Look at the accountants. The accountants are referring entities, or they're doing the forensic accounting to do the retrospective value. So you got to find a different path to basically market your skills.
Ross, do you have anything to add here?
Yeah, a couple things. One, I would say specialize. Pick jurisdictions, states, asset types. Specialization matters for appraisers. 2, if you really want to differentiate yourself as an appraiser doing tax work, whether it's doing appraisals for tax court cases, litigation, that type of thing, hone your skills on the witness stand. We hire dozens of appraisers a year for court cases, and the ones that really stand out are the ones that can hold their own on a witness stand. There's a lot of folks that can put together a decent appraisal, but there are very, very few folks that can put together a decent appraisal and then defend it under intense scrutiny in a public setting by a judge, by opposing counsel. So hone your skills on the witness stand if you really want to stand out. And then the third, which is a plug for Taxonics, is get market knowledge. One of the things that we have leaned very heavily into in terms of the products that we offer are selling reports, or allowing folks to subscribe to reports for particular jurisdictions by asset type that explain exactly how those assets are assessed, taxed, what happens when you buy or build a property, all of the nuances that go into understanding what a jurisdiction is doing from an assessment perspective. It covers appeals. It goes into the context of why those decisions are made, and then gives you insight into how you navigate those appeals and valuations successfully. We don't have all 3,100 counties covered, but we've got the MSAs covered. We have the process and the data and information that if folks need to order a report to say, you know what, I need to understand how real estate is assessed and taxed. And again, getting into the context, meaning we put this together with our property tax consultant hat on. So we're explaining it as experienced property tax consultants because we actually, Desiree may not want to hear this, we want more people to get into the industry. There's an entire underserved, underrepresented portion of the market. And part of what we were trying to do are give people the tools and the information and data that they need to arm themselves to be able to provide these services to that underserved portion of the market. And so if you're an appraiser that needs to understand exactly how it works in a jurisdiction and wants really good contextual information, that's where Taxonics really shines. So that's the plug for the company. So specialize, get good market information to understand processes and methodology, and then hone your skills on the witness stand.
I have one comment to that, or a plug for the Appraisal Institute, is start out by taking their series of 3 litigation classes that they offer. I did that a number of years ago, and it's just a great point to start since you won't start day 2 on the stand. You have to build that. So,
Absolutely. Hey, Ross, I do really appreciate your comment about specialization. When I worked in the property tax appeal space, I only worked on cases that were within my expertise. So big box retail, non-stabilized shopping centers. And I never really tried to venture out of that because I wanted to be incredibly credible when I worked through the entire process.
Yeah, I mean, if you look at some of the most successful appraisers out there, they've really specialized, and they are the go-to. Because just like property tax consultants, I feel like the number of very experienced appraisers that have had a lot of time on the witness stand is fewer and fewer. So if you specialize in a particular asset, you're going to be the person that everybody calls, and that's a great way to make decent money.
Absolutely. Well, that's all the time we have for today's episode. The Valkyrie team would like to thank the 3 amazing panelists for participating in today's Opinions of Value. Please